Welcome to Episode 3 of The Spotlight. We've got some interesting developments to cover today, ranging from overly optimistic consumer discretionary and auto sector earnings expectations, whether equities have fully priced in a recession, and new investment positions from Warren Buffett and Jim Chanos. Let's jump right into it. The first signs of consumer stress are emerging on corporate earnings. Retail sales fell 0.3% month over month in May, the first drop since December of 2021. Michigan's consumer sentiment reading in June was the lowest since the index's inception in 1975. Target and Walmart appear to have overestimated consumer demand in certain general merchandise categories and are now discounting items to clear excess inventory. However, consensus sales and earnings estimates for the consumer discretionary sector as a whole still seem overly optimistic, especially if a recession is on the way. Over the last 6 recessions, earnings in the consumer discretionary sector have fallen by an average of 44% from peak to trough. Despite a slowdown in consumer spending, the sector is currently expected to grow by 10% in sales and 24% in earnings per share in 2023. Margins in the sector are also expected to expand to reach 8.4% in 2023, which is a 50 basis point increase from 2021 and an all-time high. The year-to-date revisions to 2023 earnings for Amazon, with estimates down 33%, Target, with estimates down 19%, and Restoration Hardware, guiding down flat to now -5% for the rest of the year, may be leading indicators of the downside risk the rest of the sector faces in light of current consensus estimates as we move into second quarter earnings. Retailers are getting hurt on both ends right now. Supply chain constraints and inflation are pushing up manufacturing and distribution costs, which are cutting into operating margins, while also leaving them oversupplied with delayed arrival of pandemic inventory, just as consumer demand is beginning to wane. If consumer spending slows further, traditional retailers face oversupply ahead of a major demand cliff, while discount retailers such as Dollar General appear to be in a relatively good position, as they should benefit from both excess inventories and increasingly price-conscious consumers. The S&P 500's decline from its January 3rd high has largely been driven by valuation, as earnings estimates have remained virtually unchanged. As a result, it's likely that the S&P 500 has not yet fully priced in the risk of a recession, even though it may feel like it now, as the market looks forward and begins pricing in earlier rate cuts by June of 2023, as a sign that the Fed might be able to orchestrate a soft landing and avoid severe downside earnings revisions. Q2 earnings will reveal more about the state of growth, but earnings revisions breadth remains in negative territory, and consensus SPX net income estimates, excluding the commodity sectors, has been stagnant for months, despite forward estimates increasing, meaning that future earnings for the SPX will largely be driven by commodity sectors, which is not a good sign for the overall health of the index. During non-recessionary times, the median contraction in forward EPS is around 5%, but during recessions, EPS contractions can reach 14%. This suggests that there is still more downside risk to earnings estimates and provides a tougher backdrop for equities, depending on the magnitude of downside earnings surprises as the growth slowdown continues to unfold. Warren Buffett has been building positions in oil and gas companies. According to Berkshire Hathaway's most recent 13F filing, he recently purchased approximately $26 billion in Chevron stock and $13 billion in Occidental Petroleum. Berkshire owns approximately 8% of the outstanding shares of CVX and 24% of the outstanding shares of Oxy as of the end of March. Buffett has averaged up on these oil and gas positions, which are trading near 15-year highs during an oil bull market. Despite the previous run-up in price of these shares and the sector, Buffett clearly sees the most value in oil and gas in the current market environment, as nearly 70% of Berkshire's $51 billion in stock purchases in the first quarter were CVX and Oxy. The firm has averaged up in Oxy again more recently in June by over $500 million at around an average share price of about $56 per share. Oil prices have found some support and are rising again following reports that Iran deal talks have failed and Libya has halted oil exports. Furthermore, the latest Department of Energy estimates show that there are just 27 days of supply left in the Strategic Petroleum Reserve, which is a record low. This suggests that the supply side will remain tight and oil prices will remain elevated unless we fall into a deeper recession that tempers demand. Jim Chanos, one of the world's most well-known short sellers, is betting against legacy data centers, which are facing increasing competition from the same technology behemoths that have been their biggest customers. Chanos and his firm, Kinnikos Associates, are raising hundreds of millions of dollars for a fund that will bet against data center real estate investment trusts, or REITs. In an interview with the Financial Times, Chanos states that this is our big short right now. The story is that although the cloud is growing, the cloud is their enemy, not their business. Value is accruing to the cloud companies, not the bricks and mortar legacy data centers. The largest cloud providers, Amazon Web Services, Google Cloud, and Microsoft Azure, are now building their own data centers rather than leasing from REIT-owned data centers. He believes that many of these REITs are overvalued and are on the verge of experiencing a revenue slump and slowing earnings growth. He goes on to note that the real issue for data center REITs is technological obsolescence. Their three largest customers are also their biggest competitors, and when your main competitors are three of the world's most vicious competitors, you have a problem. Following the release of Chanos' short thesis, investors should keep an eye on American Tower Corporation, Cirrus One, Digital Realty, and Equinix, as well as data center operators like Iron Mountain and Cyxtera Technologies. Earnings from the auto industry also appear to be especially vulnerable to a potential recession. During the previous 6 recessions, vehicle sales fell by an average of 32% from peak to trough. Since new cars have been scarce in the last 2 years, the sales decline associated with the impending recession may be relatively milder. Used car prices, on the other hand, have dropped 6% since January, indicating that overall vehicle demand is already slowing. As a result, the consensus forecast of a 13% increase in industry sales in 2023 appears overly optimistic. Sales are expected to grow by 7% excluding Tesla, which is expected to grow by 35%. This can be compared to just 1% median sales growth since 2000. However, the sector has already underperformed this year, down about 35%, and is trading at the lowest multiples since Tesla was added to the index. Tesla CEO Elon Musk's super bad feeling about the economy could signal a turning point for the auto industry and a potential recession for an industry whose executives have not yet shown any signs of concern. In an email obtained by Reuters, Musk stated that Tesla needed to cut about 10% of its workforce. If the world's largest EV company issues a job and economic warning, investors should reconsider their margin and top-line growth projections as well. That wraps up this episode of The Spotlight. What developments do you have your eye on? Let me know in the comments below, and make sure to give this video a like and subscribe to stay updated with our future content.